Hey everybody. What's up, Josh? Bootleg. Julian. Welcome in, everyone. Welcome in. Give everyone a moment to get in here. Just now tweeted out the link, so people who don't notice that I went live already will be finding out now. Hey everybody. Oh, I had a lot of things. So I was sitting here and I was recording a video, like I normally do. A little later than I normally start, though, because I slept too long. But the thing I kept running into was that I couldn't figure out what to cut out of the video so that I didn't make one that was 40 minutes long. So I decided that scrap it. Instead of trying to make some polished thing that I got to sit here and edit for like 2 hours, how about we just go live? Haven't talked to y'all in a while. Talk about the conference, talk about what's going on, and just do it all together. Figured that'd be the best way to go about it. So here we be. Right. So I didn't get my intro screen on. This was the intro screen that I meant to start with, but I'm not the most fancy streamer, so you guys can just deal with it. I'll flip back. Here's my desktop. So what we'll do today is a few things that I want to rattle off that I will rattle off, and then we'll just take it from there. I figure the last 3-4 times we've done a live stream, they've gone 2 hours. Don't know if it'll be 2 hours. I can guarantee at least an hour, and then if we go any longer than that, kind of depends on y'all, how interested you are, if there's still a lot of questions, or if I just get tired. So, with that, Hussein, my man, what's up, brother? We met at the conference. Let's do this. Hello, friends. Welcome back to Alpha Beta Soup Live, fresh home from the conference. I'm TXMC, and we are live on YouTube. What's up, chat? Lucas, Paul, Nathan, Robert, Al Ghul, John, Joshua, Gavris, Carl, Hussein said what's up to you. If I missed your name, sorry. Hey, everybody. Let's start over here. Yeah? Let's start with the price chart. Why does Bitcoin test your nerve unlike any other market? Well, because it is the fire alarm, as my friend Checkmate often says. It is the fire alarm that tells you the world is fucked, or otherwise. YouTube, don't downgrade me because I said the F word in the first 5 minutes of my stream, please. I'm a nice guy. So, this price chart's like really ugly. We're even down here under 40,600, which is under this red line that for a long time I was talking about on the channel about how I felt like it was a really interesting kind of support level. It's where price had closed in January, in June, at the bottoms in September. And so I was, when we were kind of chopping through this area, I was waiting for us to get back over it. But, I've observed price has been kind of ignoring it, right? I mean, like it doesn't care. It pumps over it. It comes back down. Maybe here it's finding some support at 40K, but whatever. That level doesn't really seem to be respected at all. But, what had been respected also was the peak here, the top, which is a little bit above that, which is at around 42,000. That one's also been completely ignored by this recent price action. And now here we are at time of recording that says 40,400, which is pretty ugly. This is not what anybody wants to see. And I tweeted the other day, we were coming up to this point here, which was the 382 Fibonacci retracement, if you mark from the peak to the trough here. And that was also this black line, which goes across the middle of my screen, which is the median range of the past year of price. It's the halfway point between up here and down here. And it perfectly aligns with the 382 fib. And so over here, price just rejected this level. Here we are back down. And this, I felt like this was going to happen last night because Luna started shitting the bed. Like after it's broken out over all-time highs, it's struggling, and then you get these like really hideous candles up here and up here. And last night it really started looking weak, and then before you know it, Bitcoin's kind of off to it's following suit. You know what else was there about this? Oh yeah, the parallel channel. So like this, I'm just gonna throw one of these on here. I'll use the magnet; it's a little easier. Yeah, so we're kind of in this channel here. I'm not huge user of channels, but they help to visualize price structure. And, you know, this is the median line of this channel, and here we are well below it. I mean, structurally, we have been getting candle closes that are higher lows. We've been getting candle wicks that are higher lows. But the actual retrace rally that we're talking about here on the channel, that folks like, some of you know me from going on Blockchain Backer's channel. He also talks about the retrace all the time. You know, it's hard to know with a lot of conviction or certainty that any of these pumps that we may get, this one, anything that comes next, it's hard to have conviction that that's going to be the move that ultimately results in price coming back up here and then, you know, doing whatever it does. And I think a lot of that is really because Bitcoin and all assets are correlated right now. They're correlated to what is going on with inflation, with whatever the Federal Reserve decides to do with monetary policy. All eyes are on Russia and Ukraine in the sanctions that were imposed and the wide tendriling effects that it has had on an already tight and disheveled supply chain that has been just battered into the ground after 2 years of record demand. So there's a lot of shit going on. And even though we've got some cool things about Bitcoin we can talk about, anyone who thinks that Bitcoin's going to have a Cinderella story right now, I think is misguided. And it's important that we talk about the rest of the markets, because that, I think, is what's going to give an expectation, or at least help fence in a general guideline of what could play out in the near term, as best as could be figured. I mean, it goes without saying, for those of you that have been watching me for a while, I'm not, you know, there's plenty of times I've been wrong about things I think are going to happen, about directions I think the market's going to go. And the conditions that we find ourselves in right now are the most complex market conditions anyone alive today has ever seen or tried to assess. So, you know, sometimes I might, you know, have comments from folks on YouTube or on Twitter wondering why I don't seem like I'm giving price targets, why I'm not saying we are going up or we are going down, why everything is kind of hedged in probabilities. And it's because that's the clearest I can come up with right now, right? And I'm not going to come on and lie. So this is an incredibly difficult market to read. And I think there's a lot of warning signs out there flashing that we may not get a romantic pump rally where altcoins go crazy and Bitcoin gets back up into the high 50s. We need to build into our framework at least a non-zero consideration that we're not going to get back up here, that we may struggle to get back above 52 or 51. It's just something to build into our expectations. I know everyone wants to know when moon, when retrace. Some of you who trade other coins want to know when alt season 2022. And all of those expectations, particularly the expectation of an alt season, all of those people are built into a secular bull market that we are now coming to the end of. Because for the last decade, it has been number go up. with QE after QE after QE session from the Fed, separated by a few years, crisis after crisis, it has been a nonstop liquidity fest. And we are now reaching a point where liquidity is drying up. And so everyone who's expecting the market to do exactly what it did 2017 and 2014, maybe it happens. Maybe it does happen, but the climate of those markets was not the same as the market today. So it is not always going to play out the same way. And it's possible that if liquidity gets pulled, things on the farthest end of the risk curve get shit on. That's the crypto space. Bitcoin is the least volatile of the most volatile asset class. So I'm going to pause for a second before I keep going here. I'm going to catch up with some of you guys in the chat. It's just a wick, TXMC, just a wick. We'll close above the 100-day. Maybe, Gino, I appreciate that you have confidence and that you're feeling good about it. I am an incessant pragmatist, and so it's in my nature to express both sides of it, right? If it starts to go up, then we've got no problem at all, right? And everyone will be happy with number go up, and they won't care that I was wrong. But if I don't express the bearish side, and we go down from here, and I didn't put those thoughts out there, I wouldn't be able to live with myself. So that's where I'm coming from. I'm still waiting for you to understand that Fibonacci is a hindsight bias machine. No, it isn't. It's not a hindsight bias machine. People who use Fibonacci's correctly use them effectively to predict future movements of assets, not to the penny, but to a zone. It works. They've worked forever. I mean, people use Fibonacci's incorrectly a lot of the time, I would say. They don't place them in critical pivots. They just throw them somewhere in the price action. And you can get a lot of hindsight bias with that. But I'll just disagree with you on that. Friendly disagreement, of course. Will the Shanghai lockdowns and port closures have a major impact? So I was reading some about that earlier, and I'll talk about some of that in a second, the small amount that I know. And Shanghai was going through some lockdowns. They were still going to let people work at the ports so that they were processing shipments and things that were coming in. But a lot of the land access to the ports for like freight is not open, is closed off, and doesn't have people working them. So there could be some serious knock-on supply effects from what's going on in China. If you haven't liked the video and you've been watching this, please give me a thumbs up. If you're not subscribed, please give me a subscription. If you're interested in this content, if you find it valuable, I would love to have your support. I should throw that out there now instead of waiting till we're an hour into the stream. We all have to wait for November 2023. See which blockchain rise from this accumulation phase. Yeah, I think that if I'm understanding your point, Gael, Gael, I hope that's how I said your name correctly. I think you're saying that we don't know what's going to survive this bear. That is true. There are a lot of coins. I guarantee you over here on my random, like just crypto watch list, which has just got like a bunch of random tokens, I bet there is a percentage of coins on here that will not be around in 3 years, or they will have like reached generational lows and no one will care about them and they will essentially not exist. That's going to happen to some amount of coins over here. Does this market feel like 2018? Well, so I wasn't in I wasn't in Bitcoin or any other crypto tokens or anything in 2018. I was in equities, and this doesn't feel like that. So, CPI data, yes, Joshua Tree, thank you. We are going to talk about that. So, there's a couple of things happening this week that I think are of importance to the market, and they are both tomorrow. So tomorrow, April 12th, Tuesday, at 8:30 Eastern, which is an hour before the market opens, we get the March 2022 CPI. I don't know why I said 2022. We get last month's CPI report, which will have the war premium fully baked in, right? When in February, in March, when we got the February one, it was kind of on the cutoff. Now we have experienced a full month of the Russia-Ukraine conflict and all of the market effects of that. are now going to be in this. Now, when you look at expectations, so UBS is a financial firm here in the US, and they're one of the ones that puts out their expectations for CPI reports before they come out. And they've actually been aggressively predicting higher inflation than consensus estimates, and they've been right a lot of the time. And so I think it's valuable to look at what they think is going to happen. They expect tomorrow, guys, I'm going to make this a little bigger in case you can't see it. They're calling for 8.5% CPI tomorrow. And that will have been for March year over year, right? 8.5% would be the highest value since December 1981, which predates yours truly. Now, anyone who pays attention, anyone who's a citizen of the world out there buying food and fuel and paying for your living expenses probably knows that 8.5% is a joke. The real number is probably like 12 to 15%, let's be honest. But 8.5% in a doctored basket of goods is like a shocking headline CPI number. That's crazy. Now, UBS is predicting a downward slope after that. They think tomorrow's CPI report, which will have been for March, will be the high point. And they base that on supply chains loosening. Now, I'm not a supply chain expert. I should not be your go-to source of alpha on supply chains, but I try to do research. I try to learn. And there's a lot of evidence out there that the supply chain situation is not about to get better. There's a lot of shifting demand from goods to services. And inside of that, the supply chain itself is experiencing a lot of changes. There was an article I was reading earlier, and it was just talking about shifting costs, and there was some buildup of ships, in port in China. And I'm not going to go into all of it because, as I said, I'm not an expert. But there's just a lot of evidence that the market of supply itself is not about to start opening back up. There's kind of a bullwhip effect that they call in supply chains, where when you get a surge of demand at the consumer level, which is what we got 2 years ago when the Fed turned on the money printer in 2020, when the COVID crash happened. We got a surge of demand for goods, right? Everyone is sent home. The economies are shut down. Services get absolutely battered. Money is pumped into the economy. Everyone's given cash. And all of a sudden, demand for goods skyrockets, right? Remember, everyone was doing DIY projects. People were buying stuff on Amazon. They were home shopping. No one was having to go anywhere. And they had all this money, and they couldn't spend it on services. So we created a massive demand push inflation effect by throwing money at people and by the other things I mentioned. So what happens when that occurs is there's an immediate surge of demand at the consumer level, and it rolls its way up through various points of the supply chain, right? To the people who actually put products on the shelves, to the intermediaries, the producers at the warehouses, the manufacturers, and then the materials providers of the producers. It bullwhips up the chain as increasing levels higher in the supply chain ramp up production because of a spike in demand at the base level. It's called a bullwhip. This is a known phenomenon in supply chain 101. I'm not making this up. And so that's what we dealt with. And it takes a long time for those things to smooth out. We're not anywhere near that. So that was kind of like a little tangent on why things that I'm reading about and learning about and would love to hear counter arguments to that make me feel like we're not about to see supply chain congestion easing anytime soon. Does high CPI make the number go up? DG, no and yes. So CPI is a report of the number going up. So, it can have psychological effects on the market afterwards. Things can tighten as a result of seeing confirmation of high inflation, if that makes sense. People suspect things are going badly. They suspect everything is getting tighter, things are getting more expensive. Then they get confirmation. The official number is the highest number in 25 years, whatever. All of a sudden, they start tightening their belts. Maybe they raise prices preemptively. Who knows what the causes are, right? These are the tendrils that I'm always talking about. It's so complicated. But yes, there is, in a way, kind of a symbiotic relationship, but it's led by number going up first. "20 to 30% is reality in my community." Yep, live and learn. I believe that. If we don't see much funds flushing in crypto, would the price hold or go sideways for a long time? NAND price can go sideways for months. Months. I mean, price essentially spent, minus the COVID crash, price spent a year in like a tiny sideways box. It can do that. It did that in 2018. And I think there's just general weakness across the crypto market. I was looking. I don't look at a lot of other tickers as part of my assessment of Bitcoin. A lot of other crypto tickers, but I was kind of just watching Bitcoin, Ethereum, and Total 3, which is the crypto market cap minus the other two. And Bitcoin first got under its 50-week moving average, which is this orange line here. I'll turn on my indicator names so you can see them. It got under that, and I was waiting to see the other two make their way down there. And lo and behold, ETH and now Total 3, they're all under the 50-week again, after spending several weeks above them. Not great. I mean, the moving averages are a lagging indicator, but a lot of people look at them. So when people see that it's now under the 50-week, they react. Unfortunately, the stock markets treat BTC as risk on at the current moment in time. Yes, Joshua, they do. They have high correlation. Let's see what equities are doing. And look, equities are really taking it on the chin too. NASDAQ in particular is getting smoked. And that's because the NASDAQ is probably the closest analog to crypto, right? It's heavily tech biased, which are on the front end of the growth curve. And it's just getting battered. Whereas the S&P and the Dow, they're a little more resilient. They have more diversification within the index. And so they don't get hammered quite as much when risk on goes risk off. What's up, Coob? What's up, my dude? And what's interesting about the S&P itself, it kind of holds true for the Dow as well, but the S&P is the one most people look at. And the S&P has really been getting battered, but it's held up in part because it's insulated as a result of the 5 biggest tickers. So the 5 biggest companies in the United States by market cap are all in the S&P, right? Apple, Microsoft, Google, Amazon, Tesla. Those 5 companies are all in the S&P, and combined they make up 40% of the market cap of the index. Just those 5 companies. The other 495 companies make up the other 60%. Here it is. These big ones up here make up, like I said, 40% of the index or so. And this is 3-month performance. Now, there are some like random subsectors that are doing well, in kind of their own way. Consumer defensive, healthcare, energy. They're doing pretty well. Berkshire Hathaway, as the flagship of value, is doing all right. But everything else is just getting smashed. Where Microsoft, Google, Amazon, Tesla, Apple, they're all about 5% down, 2% down. Tesla's almost break even. A lot of this other stuff in the index here is down 15, 20, 25, 34%. Just absolutely smashed. But they're smaller market caps. And so their weighting on the index is less. And these 5 stocks up here benefit tremendously from passive investing. There are passive flows going into these stocks, and a few of the others on here, but these 5 predominantly benefit these blue chip tech stocks. And so they're really kind of holding up the index. And some people have been kind of bear posting about wanting to see something like Apple to really take a 20% hit. And I don't know if that's actually possible unless the whole market takes a much bigger hit, like twice that, just because of how many funds have large allocations to Apple, how many other ETFs have large allocations to Apple. And I'm just using them as an example, right? But this index as a whole is greatly imbalanced by blue chip tech that tends not to react as grossly to market changes. So we got a little bit off subject here. We're talking about the S&P, but it's all because of inflation, right? I started talking about inflation and how tomorrow is that report. It comes out an hour before the market opens at 7:30 my time. It's 8:30 Eastern. Market opens at 9:30. So if we get 8.5%, if UBS is correct and we get more 8% or higher, we get another step up in inflation. I think markets won't like that very much. They are expecting tightening. If you look at like Fed funds futures, if you just look at stocks generally, clearly the market expects tightness. But I think that if we saw something like 8.5%, the highest value in my lifetime, then I think we'll see some more downside. But the thing that's actually more interesting to me tomorrow than the CPI report itself, we all know it's going to be bad. You know, its degree of badness we could debate, but we all know it's going to be ugly. But the thing that actually interests me more tomorrow is what happens at 12 o'clock Eastern time, noon. Governor Lael Brainerd is giving comments at this Wall Street Job Summit. So who is this? She's one of the Federal Reserve governors. She's one of the most dovish ones. So she's most in favor of easy policies. She doesn't want to go super aggressive on QT, that kind of stuff. She's like the polar opposite of Bullard, who is the one who wants to do 75-point basis hikes at every meeting and enact the most aggressive QT in history and just shove the market into a recession. She's like the opposite. Well, interestingly enough, last week, that very governor, Ms. Brainerd, came out with incredibly hawkish comments. She started talking about reducing the balance sheet, which is what quantitative tightening is. It's the reduction of assets on the federal balance sheet. She started talking about aggressive QT. She started talking about 50 basis point hikes. And just that kind of language coming out of her, it's orchestrated. These things don't happen by accident. She didn't just wake up, change her mind, and suddenly, the news cycle goes crazy. The Fed governors agree on who's going to go out and talk about this stuff. And she was decided upon to be the one to go out, do a heel turn, show some hawkishness, and let the market know we're serious. Because we already had Bullard come out here and spread max hawkishness in February, and that was when the market was thinking we'd get 50 basis point hikes at that meeting in March. Well, anyway, she's given some comments tomorrow at 12 o'clock. Yeah, it is orchestrated, 100%, Gino. She's doing her job. And they want the markets to believe that they are 100% serious about taming the inflation beast, right? Of taming the tiger. But those of you who watch my channel, who watched my video a couple of weeks ago called The Inflation Playbook, you understand that there are very few options available to the Federal Reserve to actually deal with inflation because of how high debt levels are. Because of how high debt levels are, they're the highest levels since World War II. I think this is actually higher than World War II as a percentage of gross domestic product. Federal debt is 120%, down from 130%. So over the past year, they have been able to whittle 10% of the national debt down. They have to get it under 100. They really need it under like 80%, because that's where it was back here. Every time we've enacted QE before the past couple of years, before the last 5-year period, federal debt was not at 100% of GDP like it is now. Powell is no Volcker, and the debt is too high. 100%, you're correct. If they were to actually raise interest rates to the point where they produce positive real yields, which for those who I think I'm speaking Klingon means that the treasury yield of like a 10-year note will earn you more than the expected inflation rate. That's what a real yield is. That means that if you take away all the magic, you're still getting some money at the end of the day. A negative real yield is what we have now, where the treasury yield is, say, 2.5% and inflation is 7.5%. You have a negative 5% real yield. So if the Fed wanted to create positive yields in the bond market, to make them more appealing, to raise the cost of capital, they would make the paying off debt exorbitantly expensive for all holders of dollar-denominated debt. It would crush them. American homes own dollar-denominated debt. Emerging markets own dollar-denominated debt. Major exporters of goods to the United States own dollar-denominated debt. And we can't create a situation where the debt is unable. This is a complicated market to discuss, but the point is you can't raise rates too high without crushing the debt levels where they are. You have to allow debt to be brought down as a result of high inflation, because high inflation makes paying off debt in previously denominated buying power much easier. So they have to allow it to run high while also making average retail think that they're serious about it. So we play this dance where they come out and they say things to Bloomberg and they give these very hawkish statements and they raise interest rates 50 basis points or 25 basis points, but they know in their heart of hearts that there's no way they're going to catch inflation. They've got to let the market sort it out itself. So I hope that I was able to explain that. This is really complicated, and I'm trying to relay it in the way that I understand it. Okay, I'm not a traditional economist. I never worked for the Fed. I don't manage a fund or anything. Right? I'm doing research and I'm passing it on. So it's very complicated, but essentially there's too much debt and we've done too much money printing, and the Fed has waited far too long to start addressing these issues. They have very few options. And as a result, the market needs to tighten. And I don't think people have really gotten this into their heads yet. Does continuous high inflation favor Bitcoin as an inflation hedge? Not at the current time, it does not, Alexander. There may be a day where Bitcoin serves its true potential as a hedge against inflation, in the way that people talk about it being a hedge against inflation. But as of now, the majority of investors still treat it like a risk asset. It's far out there on the risk curve. And that's part of the reason it being the premier risk asset and being the closest thing to a free market that we have causes it to be the fire alarm. It tends to move first and tell you when things are broken or when bluffs are being called, right? So it's not an inflation hedge yet, but it is kind of the canary in the coal mine, I would say. And it's benefited by having a 24/7 market. Gino says the Fed not only doesn't care about inflation, they can't do much about it. Yes, that's true. They can't do very much about it. It's gotten far too high. It's embedded deeper in the system than they can do much about. And what they usually do is wait until the market experiences its growth and then starts reacting with tighter policy. They raise interest rates. They eventually break something and they have to reverse course when the market crashes. That has played out 4 or 5 times in my lifetime alone. And that's probably what will happen again. Only now they're doing it with 130% debt to GDP. Does tightening rates always result in a contraction of the economy? Yes, Grant, because you're making money more expensive. And we have a credit-based economy. Everything functions on debt, on credit. And when you raise the cost of that credit, everything up becomes more expensive. Because Economics 101 is that all costs are passed along. And when the cost of the unit of exchange itself becomes more expensive, everything that it touches becomes more expensive. I hope I explained that correctly. Another thing I saw related to inflation, we're talking about it here. So this is someone I follow. Guys, if you don't follow Macro Alf, this dude's great. He's a great macro economist. He's a free newsletter. He's on Twitter. He's very friendly and active. I recommend him. Good follow. He's been posting about these ships waiting in Shanghai. So if you look at this chart, I know it's a little bit fuzzy here, but let me just talk you through it. So we're looking at the number of ships that are sitting, waiting in Shanghai to load or offload their cargo, right? The average is in black, like the 4-year average. The blue line is last year from January to December. See on the axis at the bottom? The red line is right now, is 2022. So not only is it higher than it was last year at any point, it's higher than it was at any point in the last 4 years. These are ships full of cargo at, I believe, like the second or third busiest port in the world that can't unload their supplies or access a shipment to take it elsewhere. And this is in the very same place where there are now citywide lockdowns. So when we talk about what the market is going to do, that's why I go down all these rabbit holes, guys. Because everything is connected. They raise the cost of capital. It raises the cost of borrowing. People that access debt to buy resources to then produce their goods, they find it tighter and less ability to operate as a business. And then they stop ordering quite so much. And before you know it, they start cutting jobs. And the entire economy starts pulling back. Everything touches everything else, and it creates a daisy chain. So it's important to try to, you don't have to understand all these things. I certainly don't. I'm admitting that I don't get how all of it works, but I endeavor to understand enough of it that I feel like I'm being respectful to all the factors. Why could Bitcoin be an inflation hedge? Because it can't be debased, knees. Because it has a fixed supply with scheduled issuance. Because it has no human control. It is the purest form of money that humans have conceived of thus far, purer than gold. And it's the most pristine inflation hedge when it reaches maturity. But that's the issue. That's the thing that people don't quite grasp, in my view, when I have these conversations with folks, is that Bitcoin has to reach maturity to become an inflation hedge. Until then, it is a volatile, growing technology. It's a payments platform. And in a little bit, what I'd like to talk about before the stream's over, I'd like to talk about the Jack Mallers announcement at Bitcoin conference a little bit, speaking of payment systems. But we'll get there. This stuff is more important, I think. Nature's Symmetry with the $5 donation. Keep it up. Thanks a lot, man. Man or woman, he, she, they. I thank you very much. Live and Learn says, the $1 million question. When does Bitcoin do what maxis say it will? Fix everything. Fix store value. 2025, 2030, 2035. Good question. Good question. I don't have a year that I could give you. I think it will take at least a decade from where we are now. I can say that. I don't think it's going to be in the 2020s. I think that the fiat Ponzi has one more melt up leg to go. Like loosely, what I think, if I had to just like do a stick figure depth expectation of the economy, I think we're in for some downside, and then another crazy surge to the upside, and then the wheels on everything come off, some kind of a generational crash, and then from the ashes rises Bitcoin and sound money. Now that takes years to happen. Some of those things are happening very condensed and very quickly at the front of the timeline now, but the world reaching a consensus about all of these events and then playing out globally, that takes years. What do I think of Crypto Hayes' writing pieces? So Crypto Hayes is Arthur Hayes. He's the founder of BitMEX, if you guys don't know who Nees is asking me about. Crypto Hayes is his handle on Twitter. Like I said, he's the founder of BitMEX. He posts recently. He's been posting a lot of writing, and it gets a lot of waves because he's a popular guy. You know, if you've ever heard the meme "Run the stops," "Run the stops," I need a new Ferrari. That's Arthur Hayes, right? Because it's a joke. You know, back in the day of BitMEX, you know, as market makers, they would run the stops of the plebs, and Arthur is a very wealthy man, so he's kind of a meme in the leverage community in Bitcoin. So he writes a lot of things about macro market theory and what he thinks Bitcoin and Ethereum are going to do. And what I would say for those who read Arthur Hayes, and I have some friends who have these similar sentiments, and they've expressed this in more eloquent ways than me. Arthur Hayes is a counter trade signal. Okay, he is a fucking billionaire. At minimum, he is a centimillionaire. He is a market maker. He is in the group of market makers. He may not actively do that himself now, but that is his clique. And he is the 1% of 1% of people who their size is really size in the market, to use a trading meme. So his bias, his motivation, and his incentive structure for sharing viewpoints in a very public way, knowing that he is a popular figure, those incentive structures are very different from if I wrote the same thing that he wrote and shared it on my Medium page. Because I'm just TXMC. I'm not the founder of BitMEX. I'm not the founder of the Run the Stops meme. I am not standing to possibly gain from market positioning and reactions to my stories the way that someone like he is. So if you look at his last few stories, he has been dead freaking wrong. Dead wrong. I'm going to go find my friend JS because he posted this last night. And I agreed with him completely. Where is he? Where's my homie JS? Well, JS posts a lot of random shit. Wow. He's been posting a ton. Where is his Arthur? Well, can't find it. Anyways, basically his point was Arthur's been wrong the last few times he's posted a story. He told people to sell at 30K. He told people to buy at 44. And here he is doom posting at the lows. So he also admits that he has a position open. If you read his thread, read his post, he talks about his positioning in there. Now, he talks about a lot of economics. He talks about Felix Zulauf, who is a great economist. Some of his views about the bigger picture I actually find intriguing and interesting. But when he talks about what he thinks price is going to do in the next month, turn that shit off. Do I think Bitcoin can break below 30K? Gassan, yes, of course. Let's go look at the price chart here just for a second. I know I've been talking a lot about economics and inflation and all this stuff, and this is predominantly a Bitcoin channel. So I appreciate y'all whose eyes and ears might have glazed over there as we dove into all of the economical stuff. But yeah, sure, Bitcoin could go below 30. There's no reason why it can't. Especially if we get a correlation one moment in markets and everything sells off. We're not that far away. You know, it's only $12,000 away. We're closer to 28,000 than we are to 53,000. Guys, if you've been watching me for a little while and you have not liked and you are not subscribed to my channel, you've not liked this video, please hook me up with some support. I really appreciate it. Doing this, making these videos with you guys, talking about the markets, putting them on YouTube, helps me to have the freedom to continue doing it. So I really am truly humbled and grateful for all of you who spend time hanging out and chat with me, who watch my videos, who give me the thumbs up, who leave comments for the algos. Thank you. Thank you very much. He's long shit coins. He might be. Yeah, I think he said he was even buying some random alts. DG Arthur Hayes was buying some random alts. I mean, look, I've got some random alts, guys. Like the vast majority of my holdings at this point are Bitcoin, but I have some like random alts. I don't like to talk about them on my channel because I like to focus on the better money and to focus on the broader markets. My channel is not a crypto trading channel. I'm long some alts, but I don't give a shit what happens to them. They could go to zero for all I care. They're not long-term plans for me. Bitcoin is probably not going to zero. I would probably heavily discount that. So I just dump my spare money into that. And I don't really care what the price does. I listen to you because you take many other variables into context and how that translates into the Bitcoin market. Many people keep their nose on the map and really zoom out. Thank you. Thanks, Grant. I'm trying, buddy. Really am. Thank you. It's not all about Bitcoin. Step outside the box. Yeah, I would say so. I mean, Bitcoin is important. To me, I think it's the most important monetary discovery of our lifetimes. And in time, will come to be understood as such by people who still don't. What are Bitcoin wallets doing? Don't know, Mighty Mustache. I would not recommend people spending too much time looking at wallets. So I do want to show you an on-chain chart because I posted it last night and some of you asked me to talk about it. So I figured we could rap a little bit about long-term holders if you guys don't mind. Don't get caught up in the hopium. Nope, no hopium here, Stale. Thank you, sir. If I call someone a sir and they are not a sir, I apologize. But yeah, Mighty Mustache, thank you so much for the donation. I really appreciate the $2. And I wasn't trying to be flippant when I said don't look at wallets. I just mean that I don't believe that there is much signal to be derived from looking at wallet distribution. Because there is more nuance than interpretive signal out of that data. And I would encourage people to not look at those things. Don't look at how much whale supply there is. Don't look at the number of whale addresses. Don't do that. You are not doing yourself a service. And if the whales are going to do something, it will manifest itself across a host of metrics because they're whales. So don't look at whale balances. Don't do it. That's my recommendation. My mic went out? You guys can hear me, right? Okay. I wanted to make sure. I mean, it looks like it's still making sound. But someone in the chat mentioned that it had gone out, so I'm not sure. Okay, wonderful. Okay, so someone asked about, please talk about short-term holder realized price and their cost basis. Okay, before I do this, I'll look at short-term holder cost basis. Sound good? Let's do that. Okay, they're the same color. All right, let us change the color of the short-term holder cost basis. All right. Currently, as of the most recent, Mike has noise cancellation, so when I stop talking, it gets really quiet. Yeah. Yeah, because if I didn't have noise cancellation on, man, y'all would hear all kinds of stuff back here. Okay. So, short-term holder cost basis. For those uninitiated who are hanging out in the chat, what is this? So short-term holders are holders of Bitcoin that have acquired those coins within the last 5 to 6 months. The coins have moved within the last 5 to 6 months. Their cost basis is somewhat relevant to us because it represents the average price of all Bitcoin recently transacted. And what we like to see when markets are showing strength is that the price is able to stay above their cost basis. Maybe it comes down to touch it, to give it a little kiss, and then it moves on. What we don't like to see, if the market is going to be a market of strength, is to see price underneath the cost basis of the newest holders and staying there, because it indicates a lack of strength, and it's showing that they are just continually getting their money back rather than realizing profits. So the short-term holder cost basis, which is again is the average price of every Bitcoin that was moved in the last 5 to 6 months, is in purple here. It's this purple line. So when we talked about it for the first time on the channel, it was in December. It was just before we had a really hideous liquidation event. And the short-term holder cost basis at the time was $53,000. And we saw price bounce off of it and come down and look like it wanted to go below it again. In fact, I'm going to zoom in a little more so we can see it even better. Zoom way in here. Here we go. So this is July. Here's the September peak. This is the day El Salvador made Bitcoin legal tender. Here is the day in October when the BITO futures ETF launched over here. Then here's our all-time highs, right? And here's the short-term holder cost basis. We came down to it. We did a little bounce. And then on this day, this was December 4th. There's a video on my channel called There's Blood in the Water. And that channel came out on that video came out on December 4th, and we talked about this liquidation event. And that day, we broke below the short-term holder cost basis. And what we've done in the last few months, you can see it's kind of trailing down here as the average price of coins moved is lower, and it's pulling down the average. This line is, in a way, kind of like a 155-day moving average of price. 155 days is the technical middle of the cutoff for becoming a short-term to long-term holder, becoming long-term. So 155 days, if you put a 155-day moving average of price on here, they would be close-ish. They don't move exactly the same. This one is kind of like a volume-weighted version of it. We did get back over it recently. I tweeted about this the day that it happened. And I said, we got back over the short-term holder cost basis. Let's see if they can turn it into support. Well, we know that they didn't, right? And now price is 42,000. Well, the short-term holder cost basis right now is 46,800, which is very close to some technical levels we talked about at the beginning of the stream. I'm going to go back over here to the price chart real quick. Here they are. Take off some of my drawings. I'm going to put on a fib. Put on the retraces. So right here is the 382 Fibonacci retrace, right? We've talked about that a little bit. And then also, if you look at the entire range, if you mark up the high in April and the low in July. Oops. I didn't save it. Sorry, guys. I'm doing this live. I do a high, mid, low. The median, so the exact middle of our price range, the dead center is right there. It's also, as I just said, the 382 Fibonacci retrace. And it's also, as I just said, the short-term holder cost basis. So 46,000 has a lot of confluence right now between technicals and on-chain. And when I see confluence between technicals and my beloved Onchain, that feels like a strong level to me. It feels like something important that we need to conquer in order to have the next phase of the market. That may or may not be true, but that's kind of my framing of it, because confluence between different schools of study on the same asset typically strengthens the signal. Thank you, Dougie. Thank you for that kind words. Thank you so much. Anirudh, I hope I said your name correctly. Thank you for calling me the best. I don't know if I am, but I really appreciate that. Thank you. All right, so that's the short-term holder cost basis. This other orange line down here is the cost basis of all coins. We call this the realized price. And this is the average cost of every Bitcoin that last moved on chain. We've explored this metric on the channel several times. This metric gets broken below in bear markets, in flush outs, like it did in March of 2020. It is now at 24,500. We're quite a ways away from it. But if we lose the summer lows, the realized price becomes a magnet. That's something to think about. So I want to touch on this chart briefly. 24K is the average price of all Bitcoin moved on chain. Yes, it is the cost basis of the entire network on the base layer itself. So what I wanted to mention here, we just did a nice little crash course on short-term holders, right? Well, there is another cohort. It is the long-term holders. They are the ones who graduate out of short-term. They hold their coins 5 or 6 months, long enough that they pass through the threshold. Glassnode's algorithms do their thing, and we consider them long-term holders. And the reason that's important is because when you look at the ledger's history over 13 years, coins that sit dormant past the 5 to 6 month or so time frame, the statistical likelihood of them being spent after that point is very low. It's past a point of relevance. And so we say that they're unlikely to be spent, statistically unlikely to be spent. And that makes them a hodler. It makes it easier. Basically, the simplest way to think of it is the longer you hold your Bitcoin, the easier it is to keep holding it. So that actually works in the data, and we can see it. Strange, Plan B have nothing to say about his plan. Plan B follows me, and I'm strangely one of the only people in Onchain that he hasn't yet blocked somehow. I don't know how that's possible. I guess I haven't called him out in public yet for his stock to flow model being absolute garbage. We'll see what the future holds. So this chart here is showing you some of the behavior of the long-term holders. And we're not going to go through every single element of long-term holders, but there was a couple of things here that I thought were interesting that I noticed when I was looking at this. So long-term holders, their cost basis exists in the past, right? As by the nature of them being a long-term holder. They didn't just acquire their coins today. They have their coins from the past. And so their cost basis is moving on a lag. And the average cost lives at some point in history. The spending price. So every day there are some long-term holders that spend. They transact their Bitcoin. We say it's statistically unlikely for long-term holders to spend. That doesn't mean that they don't. It just means that they are a very tiny percentage of spending on a given day. There are times when they spend more. It's usually when we're breaking into all-time highs. Those are the moments where they spend most of their Bitcoin. The rest of the time, they tend to be quiet. But every day there are some hodlers moving their Bitcoin from a point in the past, and we average those prices. And if you average those prices out, what we'll call a spent price, so it's like the outgoing cost bases of these old coins, that's on this red line. And it is following the long-term holder cost basis, which is this blue line. Now again, their cost basis is the average of all of the Bitcoin from 6 months and older that haven't moved on chain in a long time, and the price that they last transacted at. Well, what I've been seeing about these long-term holders, now that I explained all that stuff, you can go back and watch this again if you need me to go through those explanations, but I want to get to the point here. And the point is that the price at which long-term holders have been spending their coins recently has been going up. It's been getting higher, which means that they are spending closer and closer to the current price. I'm zooming in a little bit more here so we can see it better. Now, right here, I'm going to actually bring up a drawing tool because it'll make this a little easier. Okay. There. Okay, here's my drawing tool. Let me make this a nice contrasting color for you to see. Here we go. So the first thing to note is right here. Now, the price at which long-term holders spending today, the hodlers who are transacting right now, are spending at the highest average price that they ever have, meaning that the coins that are moving out of this group, the coins that hodlers are spending, have the highest average cost than they've ever had, higher than when we were at the all-time highs in October. That's interesting to me, because this happened as a result of a multi-month bull market, right? And we're pulling up, and then people from back here who have been holding from the previous run are cashing out on the way up, spending at higher prices from back here to get out. Those are people who didn't quite hold long enough to build conviction. They're spending into the rally as price gets nearer to their cost basis, and that's why we see their spent price rising. Well, the recent transactions have printed even higher average prices out of these hodlers, which means that the vast majority of the coins that are getting spent by hodlers here at these terrible prices in this really ugly price action, the hodlers that are actually moving coins have coins from the relatively recent past. I believe these are hodlers from here, from here, from here, from here, because their average price is above 33,000. This group is averaging 34,000, which means some of them are up here in the 40s and 50s. Some of them are spending from maybe down here, maybe down here. But the average is 34,000, which is the closest it has been to the actual price since the COVID crash. So I just thought this was interesting. This isn't saying anything about it being a bull or bear market. I mean, if anything, it's showing mid-cycle bear market behavior, because long-term holders, mature investors, they tend to want to spend their coins when there is a high profit motivation. They don't just spend whenever. They don't just spend because things look bad. When we look back through the history of spending from long-term holders, most of it happens in price discovery, which means when we are at all-time highs and making new highs. They spend when there is a profit motivation. Now, they do that because they have the benefit of a low time preference. They've been holding for long enough that they've weathered some volatility. They have maybe come to understand the asset a little better than they did at first. And the longer they hold it, the easier it gets. So we don't normally see a lot of capitulation out of long-term holders. They tend to hold tight or spend into highs. And what we're seeing here with this rising average price of coins leaving long-term holders and bringing this, it's charted down here at the bottom as what I'm calling a premium, but it's really just the distance between these two numbers, between the average price of their spend and the current market price. And it's at the narrowest margin it's been at since July of 2020. And that was in the depths of a bear market. So I think this is an interesting view, because it's showing us that the people who have profitable coins, which is the majority of holders, the standing unrealized profit ratio of long-term holders is 2.7. That means they're currently sitting on 370% profit as a group on average. They're sitting in massive profit. So seeing spending out of this group that is at a mild 18% premium to price is really showing you they are the newest hodlers. They barely qualify as hodlers because they have just recently graduated into this group that we call long-term holders. Enrique says, what platform is this? This is called Tableau. Tableau. So we're seeing pretty stout behavior out of long-term holders. However, they're no longer gaining supply. They've kind of flatlined. And I believe they've pretty much reached saturation. And we may see a little bit of additional growth out of long-term holders, but really their supply has kind of flatlined. And I'll put it here on the chart for you, and I'll show you guys. Drag long-term holder supply over here. Close up my data sources. Let's turn off 0 so you can see the curve a little better. All right, so this is long-term holder supply, okay, down here on the bottom. Don't know why it's gone. Take these off. Yeah, so this is long-term holder supply. It rises in bear markets. It falls in bull markets, right? These are people spending their coins. So the coins have their lifespans reset to 0. They become young coins again, and they leave the long-term holder group, and they join the short-term holder group. That's what happens in a bull market. It happens in every bull market. I've written extensive research about this on Glassnode's Insights page, if you want to go check it out. I have an article called Following the Smart Money, where I talk about this dynamic in detail. And what we're looking at here in the last, couple of months, I'm going to zoom in on the last 3 years because this is a lot of history here. But what we've seen with the long-term holders, look, so this was their supply rising up to kind of its what we call peak hodl, which they reach a point where they own as much of the market as they're going to be able to own. Because there's always a percentage of coins that stay short term. They stay moving. They don't get a chance to age because they are part of an exchange balance, or they belong to some intermediary, or they're involved with some kind of trading. Who knows what the reasons are? But there's always a population that lives in short-term holder supply. It's never going to go down to 0 and have all hodlers owning everything. So they tend to reach a point where they're at max saturation. And they reached that point right around October. This was the highest point of nominal supply that long-term holders have ever owned. It wasn't the highest percentage of circulating supply, but it was damn close. It was basically as high as they could get. And it came after many months of steady maturation. So when you see this really smooth rise in long-term holder supply, remember, coins join this group on a delay. So the reason it's so smooth is because this group isn't doing any spending really at all. They're just sitting around, and coins that were bought 5 months ago are slowly joining the group every day, piece by piece. And so they get this nice, smooth curve up as they absorb more supply. Well, we got to this all-time high in October, and it went flat. It's gone sideways. Now, there are always coins aging. Every day, there are coins maturing. The default state of a Bitcoin, your Bitcoin right now is aging, sitting in your wallet. It's not moving. It is gathering dust and coin days. And every day that it sits there, it gets another coin day relative to its Bitcoin size. Every day there are some amount of supply that is entering long-term holder supply. Every day. For this value to go sideways, essentially flat, means that the spending that is coming out of that group is offsetting the maturation at an almost one-for-one clip. So the coins that are getting older from a few months ago are equal in number to the amount of coins that long-term holders are spending each day. They're about the same, and it's resulting in a flat line of the supply. And this dynamic, in conjunction with seeing that the price that they are spending at is closer and closer to the current price. Sorry, their average cost basis is closer and closer to the current price of the ones that are moving, shows that it really are some of these newer long-term holders who have a very narrow profit margin, or perhaps they are in loss even. They could be long-term holders from back here. I'm sorry, from up here. Long-term holder threshold has now passed the previous all-time highs in October and November. It's like in this part up here. So they could be holding from these highs or still from April and May and spending here. It's possible. What's the gray? This in the background is the MVRV of long-term holders. Some of you are familiar with the MVRV ratio. It's a ratio between the market cap and the realized cap. The realized cap is the metric we've been talking about, which is the cost basis of the network. It's the price at which all coins last moved. So the realized cap and the market cap form a ratio. And when you create that ratio, what you're essentially showing is the unrealized profit level of holders, right? It's the average price of all their coins against what the price is right now. And that's their profit ratio. Well, in the gray back here is that value only for long-term holders, only for mature coins. And you can see that their MVRV, their unrealized profit level, is 2.79. It's a ratio, so 379%. A factor of 2.79. Do I use long-term holder, SOPR, to understand their spending activity? Yes, I do. So this average price, this long-term holder spent price metric right here, Mr. Oliveira, is price divided by the long-term holder spent profit ratio. So you can find out what price coins are moving out of long-term holders every day by doing price divided by long-term holder spent profit ratio. Do you think anything of the high buildup between BTC open interest relative to market cap? Good question, Carl, and I did want to talk about that. So let me just drop that in here real quick. Yeah. Okay, here we are. So I've talked about open interest before. This is the amount of standing open contracts in Bitcoin futures, where all the speculation is. And recently we've had a jump in open interest back over 2% of supply, which is a level that I feel like is important to look at. I'm not the only one. Other analysts use this 2% mark. But when it gets over 2%, that is usually periods of high volatility. Many cases it's a downside flush, but the context matters based on what the positions of those orders are. If it's a bunch of shorts, it's a short squeeze like it was here in July and August. But right now we're seeing a big jump in open interest. And when I tracked this down, I found it to be on Bybit, specifically on the September future. That's an expiring future for the end of September, September 30th. And a bunch of open interest got shoved into it a couple of days ago. Like $1.5 billion worth of Bitcoin was pushed into the September Bybit calendar future. So it caused OI to jump up. But if I go show it to you, let me show it to you. Levitas. I spelled that wrong. I spelled Levitas wrong. Levitas.ch. Boom. Okay. So let me show you this instrument. Okay. This red line is volume. The green line is open interest. And the only thing we're looking at is Bybit's September future. That's what this is. BTC USD U22 is the one that expires the end of September. It just went live a few months ago. I mean, this future goes away at the end of September. But look at the open interest in green here. It went from 0 up to virtually $2 billion over a period of 2 days, from April 6th to April 8th. Massive position, and it's been kind of attritioning away. And now it looks like it's lost maybe about $1 billion, maybe 800 million of its value. I don't know what this is. I don't know if this is a major hedge fund giving itself some protection. Who knows? There's no way to truly know. But it's a big player, and they're trading on a very sophisticated instrument. These are not apes. So the kind of people who ape into 100x gigalong positions, like on Binance at the all-time highs, are not trading billion-dollar positions on calendar futures on Deribit. This is a different kind of trader. This is a sophisticated trader. Typically, that's the population of the people here in this market. So it's hard to know exactly who this is, but there's someone who probably is protecting a spot position somewhere, if I had to guess. What would the XRP charts look like? I don't know, 1, 2, 3. The on-chain data is not available for other coins like that. All right, let me see what's going on here. Looks like a couple things going on in the chat. Flaky hands from recent market participants. Yes, that's correct. That was my assessment of that long-term holder spending. All right, so I want to touch on one thing. We've talked about a lot of charts. We looked at Onchain. We looked at some future stuff. We talked a lot about inflation. Well, you got some questions here. Can I elaborate on what I mean by protecting their spot position? Well, I mean, you can short spot and long futures, or vice versa. Or you can open a futures position and then buy options. There's a lot of different complex exposure that someone who is adept at market positioning can design for themselves across markets. And that's what makes assessing these markets really challenging, is because someone could be trading this future right here and also actively be in FTX spot markets. But that same person could be trading both right now in opposite directions. How often do I use minor flows and inter-entity flows? I don't look at the inter-entity flows that much, Ben, which is like do you mean like exchange to exchange? I assume that's what you meant. I don't look at that stuff too much, if that's what you mean. Minor flows, I find the minors pretty interesting. They are not the same force on the market they used to be, but they are really interesting. Miners have started to hodl more of their stacks than they used to, though they still are net sellers. But they sell a little bit less than they used to, which I showed in a tweet actually not that long ago. And I'll even pull it up real quick and show you. And I'll show you here. So if you look at the center part of my screen right here, we've got the 4 epochs, right? These lines going down, these vertical lines are the halvings. And across the middle here is the hodl rate of miners, meaning the percentage of created supply every day that got put into their balance rather than going somewhere else. It's the net gain in their treasury as a percentage of daily issuance. You can see in the first epoch is close to half, very high. It's been getting lower. But after the third epoch, which was from 2016 to 2020, after this epoch where they only saved 6.3% of mined coins, they now save 8.3%. The miner balance is here in gold. It's this gold line. At the end of each epoch, I've got the balance on here. And if you see, it was going down here to here, it went down. Here to here, it went down. Here to here, it went up. Granted, it only went up by about 4,000 Bitcoin since the epoch change in May of 2020, since the halving. Their balance on net has only gone up about 4,000. They are holding more, yes, but they're not holding the majority. And so that is a language that I see used on Twitter. I think I've been guilty of this myself before. If you go find old tweets of mine, I might have actually said it with the wrong language. But miners still sell 100 minus 8.3% of daily issuance, or they move them out of their treasury. I should put it that way. So 91.7%. Thanks, Gassan. Thank you very much. 91.7% of the issuance every day gets distributed by miners. Either it goes to participants in the pool who get paid out, or it goes directly to a market and gets sold. So, but they are, like it says, hodling slightly more than they were before. Is most Bitcoin still off exchanges? Yes, Mighty Mustache, it is. There's about 2.5 million Bitcoin on exchanges, and there's 19 million in circulation. You're an Elliott Wave analyst. You see a lot of altcoins that have a better structure than Bitcoin. Wonder what my take is on altcoins. Well, first of all, I'm not much of an Elliott Wave guy, in the sense that I'm not adept at it. I'm relatively new in trying to employ Elliott Wave in my analysis, and so it's not one of my strengths. I'm still very early on in my wave structure analysis. If you're asking me about altcoins, so what I'll say, first of all, I try to keep my channel as Bitcoin as I can, so that's why I don't talk about alts that much. But there are a lot of altcoins that still have investors clinging to their now dead bull runs that haven't fully rotated out of them in the way that you would expect to at the end of a bull market. I see hesitation. I think there are a lot of people that are still holding on to the possibility that we get another true like alt season 2022 where everything that didn't move last year catches up, especially a lot of the like legacy altcoins, the ones from the old bull market, the previous 2018 market that hadn't really done much this past year. There's quite a few coins that didn't have the same kind of run that the newer generation of shit did, like Solana and, Avalanche, etc., Luna. But there's a lot of people still sitting in very relatively new projects that are extremely high off of their recent lows and their past market tops and have not fully been rotated out of. And I think that there is a non-zero possibility that sometime in the near future, there is a capital rotation out of those coins. And things that people assume are bulletproof because they are new and they have a lot of adoption find themselves actually down another 50% from where they are now. I'm not trying to say that as like a bear lord, but I'm generally apprehensive about market structure. And there's a lot of them. There's a lot of coins that have reached 4.236 fib extensions, and they're just kind of languishing, and people haven't rotated out of them fully yet. And I think some of those are highly suspect. Ben, do I weight any of my KPIs or metrics higher than others for general sentiment of the market? That's a good question. I've been thinking about sentiment a lot lately, Ben. I don't know that I have like a really good tool set that I like to use for sentiment. It's kind of a combination of scrolling Twitter, particularly looking at replies to big accounts. So big accounts are big trading accounts I like to follow, but then I like to see people replying to them, which is an unorthodox sentiment KPI, but it is one that I like. This is a difficult market to try to gain sentiment out of, I feel like, because there are signs of bullishness that get immediately swatted down by very real world problems. I don't know a whole lot about the Ethereum miner economy, Craig, to be able to pontificate on where I think its future goes. But my understanding is that the merge makes miners considerably less profitable. I don't know what that means for them, but they've got all this capital and hardware allocated to this venture that will suddenly no longer be profitable. I don't know. Can those mines be used for something else? That would be my first question. All right. Well, we are at about an hour and a half into this stream, and I think I might wrap it up here shortly. Just wanted to talk about all this stuff with you guys. We didn't talk about Jack Mallers. Maybe I'll do that real quick. Maybe I'll do that before we call this an end. So yeah, let's do that. Let's do that. All right. I'm going to pull up my Twitter and I'm going to go find my tweet from the other day where I mentioned what Jack Mallers announced, because we're going to talk about it. Scrolling through my Twitter. Here it is. Okay. I want to talk about this for just a minute. Those of you who've been living under a rock, a couple of days ago, Jack Mallers, whatever, was at the Bitcoin conference. I was there personally. Thanks, Forex. I am going to look into Elliott Wave for sure, my dude, for sure. Jack Mallers made an announcement, and the announcement was that Strike had partnered with 3 major merchants to deliver Lightning-powered payments to online and retail storefronts. Now, the people he partnered with are Shopify, which, say what you want about Shopify, but there's a lot of independent merchants online that use Shopify, even though their stock looks freaking terrible, by the way. Let's just go, just for those of you who don't know what I'm talking about, let's just go look at Shopify real quick. Woo! That is ugly, guys. Look at that. Where's the price range on this thing? I believe this is 70%. Yeah. So Shopify looks terrible. But the other 2 ones that it partnered with are Blackhawk and NCR. Now, NCR is a big one. NCR owns like 20% of all retail point of sale systems. That's the computer that they check you out with at the store or the restaurant. That's a point of sale. NCR is like the Walmart of point of sale. They now are partnered with Strike to allow people to use the Lightning Network to make payments at the register. And so let me explain the facets of this, because this is it's a little complex, but I think it's a massive net positive for Bitcoin, frankly. It doesn't create sell pressure on spot Bitcoin in the way that people think that it will. And let me explain that. So there are a population of people who will spend actual Bitcoin. I believe that. And many of those people are not in the United States. They live in other jurisdictions, in other sovereign territories, where their local currency experiences more volatility than Bitcoin. So let's always keep that in mind when we talk about Bitcoin can't be used as money, nobody uses it, whatever. It's happening in other countries right now. So there are people who will spend Bitcoin, but this partnership here with Strike does not require you to spend any Bitcoin. Now, if you've never used the Strike app, I'm not paid by them. I'm not shilling them. I don't care if you go install it or not. It's the business proposition that's interesting to me. That's what I'm talking about here. Now, the Strike app is literally just an app that employs the Lightning Network rails to give 2 different counterparties their currency of choice in a transaction. That's all it is. Whether that is Bitcoin, US dollars, euros, francs, dinars, yen, yuan, whatever currencies they support, the people who make the transaction on Strike, the person who makes the payment and the merchant, they get to decide what currency they want to transact in. It doesn't matter what the other person wants. Strike, on the back end, takes the currency from the payee, converts it to Bitcoin, sends it across the Bitcoin rails to one of its local nodes, converts it into the currency of choice of the recipient, and gives it to them. Now, why does that matter? That matters because fees on the Lightning Network are a fraction of a penny. They're like 3 Satoshis. That's like 0.001 of a penny. Something like that. And they are exorbitantly low. All that Strike is doing is giving you window dressing to make payments on the Lightning Network using any currency you want, because Strike makes foreign exchange swaps of their own so that you can use any dollar denomination, any currency denomination. The fact that they use Bitcoin rails doesn't mean you even have to own Bitcoin. I have the Strike app. I have 0 Bitcoin in my Strike app and I can go buy stuff with US dollars at a merchant using the Bitcoin network. And if I am a merchant who decides to now support this process, I can choose to be paid in a percentage of Bitcoin and the rest in dollars. I could get paid 50-50, euros and USD. I could get paid three ways, euros, USD, and Bitcoin. I mean, it doesn't really matter how you choose it. It's full optionality. And the reason I think that it's important, the reason I think it's going to get traction, and why it is a real threat to places like Visa and MasterCard and Western Union and American Express, the MoneyGram, those companies are traditional legacy finance. They have a lot of administrative overhead, and their fees at the merchant level. So the merchant, the person who runs the store, every time you go buy something with your Visa card, that merchant pays 2%. They're losing 2% just to support your method of payment. Well, with Strike, the fees are less than 1%. That savings is now on the merchant side. The merchant now has the opportunity to lower their own costs. Maybe they start passing savings on to you, the consumer who uses the Strike app. Stop reinventing the wheel. It's not reinventing the wheel, Grog. XRP's use case is totally different. This requires no previous agreement between the parties to transact the way that XRP does. You literally just walk into the store, boom, pay with Strike. It's over. This will change everything. And he's partnered with these retailers already. They're already part of the machines. So if you have merchants now who are incentivized to have their customers use Strike to pay for things because it saves them 2% off the top, they are now incentivized to campaign for Lightning and Bitcoin favorable legislation. It now brings the businesses into the campaign. I think this is incredibly positive. I don't see a lot of negatives, to be completely honest with you. How long does the transaction take to settle? It's instant, Dougie. It's near instant with final cash finality. Credit card payments take a couple days to settle, and you pay 2% as a store owner. Now you can pay, I'm just going to throw a number out. Let's say you can pay 0.5%, 1%, and you get instant settlement. You don't have to wait 2 days. What is the negative? That people don't know what it is yet? That will change. It's just an app. People already pay for things in apps. It also works with Cash App. And the great thing is you can pay from anywhere. So if you want to pay with Bitcoin using your non-KYC personal node at your house, all you have to do is put it into Strike as a payment method. If you want to pay from your bank, you put your bank in there. It is total optionality, and it chops the administrative overhead out of the legacy finance system because they haven't been threatened in half of a century. BTC pre-funding. Grog, I think you should go learn more about this process. I think you're kind of parroting some talking points that aren't fully fleshed out in the way that this actually works. Anyway, I need to wrap up my stream, guys. It's 2:15 local time here. I got to make some lunch and stuff, and because my kid's gonna get home from school, and I can't be streaming when that happens. It's just too loud in here. But I am really glad that all of you came to hang out. Right now we got 223 people in here. I hope there's at least 223 likes on this video. If there's anyone here who enjoys this content, you find value in the way that we talk about Bitcoin, that we talk about Onchain, that we talk about futures, economics, whatever it is, or if you just like hearing my voice, please subscribe to the channel. We'll probably do another live stream next week, but I'm going to try to put out a packaged video next. Because I don't want to only do live streams. So thank you, everyone. Dougie, you're losing me, bro. Coinbase doesn't even settle instantly. That's true. So yeah, I greatly appreciate all of you. Thank you so much. This will be saved. It takes YouTube a little while to process, and then it's up. Then it's ready in HD, and you can watch it back, including the chat. But yeah, we'll keep it there. So until we meet again, it'll be just a couple of days, maybe a little bit later this week. We'll wait for the CPI report tomorrow. We'll wait to see what Governor Brainerd has to say around noon, and we'll see what the markets do in reaction. And then we'll make a video, maybe Wednesday, Thursday. We'll see how it goes. Till we meet again, take care of yourselves, friends. Take care of your families. Be kind to each other, and we will chat just a couple days from now. All right? Cheers, everybody.